Hey everyone, happy Thursday, March 16th. It's about 11:30 on the West Coast, and it's time for another market update. Today also begins March Madness. It's always fun if you're a big sports fan or college basketball fan, but just to let you guys know, it's been madness in the markets over the last week since I left you guys. So a lot to cover, so let's get right into it. Last Friday, we got, as I mentioned last Thursday, we were getting the BLS jobs reports, which is really important. We know the Fed is paying very close attention, comes out once a month. And taking a look at the numbers at first glance, they were kind of negative for us. The business establishment survey, where they do some math gymnastics, came in at 311,000 jobs created compared to 225 estimated. But there was some negative revision, so they only netted 52,000 there. And then the household survey, where they actually call people and find out a little bit more, that came in at only 177,000 jobs created. And the unemployment number ticked up from 3.4 to 3.6, and that is something that the bond markets liked and helped mortgage rates. There was also a big jump in duration of unemployment under 5 weeks, which we know that there's not a lot of new initial claims going on right now. So that just means recently people have been having a hard time finding a job once they get on unemployment. And then also we saw some deflationary pressure, which is good for us because we know the Fed doesn't want any wage inflation for weekly hours, hourly earnings, weekly earnings. And then the other big point from this report, as we highlighted last week, they gained 105,000 jobs from leisure and hospitality. But if you look at this chart, in the pandemic, we lost 10 million jobs in leisure and hospitality. And ever since then, they've been adding back, pumping up these reports. We know in the JOLTS report, the job openings report last week, there was a decline of 194,000 job openings for leisure and hospitality. So there's really not much left here. We might start to see that balance off and not see these reports come in so hot and maybe show the labor market is loosened up. It's not as tight as the Fed thinks. So the next huge thing that happened this week, we had banks collapse. We had the Silicon Valley Bank in area where I'm from, the South Bay and San Jose area. We had Credit Suisse, a lot of different things. It's spreading in Europe. This has caused a lot of unrest in the market. It's been super volatile. It's actually been beneficial for mortgage rates, but this, like we talked about last week, this is not a good thing. We talked about the metaphor of the fool in the shower. In this situation, we're worried that the Fed and the ECB over in Europe, these aggressive rate hikes has kind of caused this situation. Now obviously these banks have done a lot on their own to cause, put themselves in this predicament, but you can't argue that the aggressive rate hikes that these different federal banks have done has definitely, hindered how they do business and had a negative effect. So one visual I want to share with you guys is this. So this is a visual of all the banks that have collapsed since 2000. The big one here, Washington Mutual in 2008, $307 billion. The next two biggest in this visual are Silicon Valley Bank and Signature Bank in New York, which had some issues this last week. So, just to go and show, these aren't two little small regional banks. These were big banks. So it's something to be concerned about. Like I said, it was positive for mortgage rates, but it's not positive for us. So we'll have to keep an eye on that closely. The next thing that happened this week, we got CPI data. CPI data came in basically as expected, a little higher than expected, but still down. But the markets did not react well. The main thing I want to highlight here real quick, because the core here was up a tenth of a point more than expected, 0.5 compared to 0.4. Shelter came in hot again. We've talked about this. Shelter lags in this data. Right now, the shelter, 43% of that core number is made up from shelter. It made up for 60% of the February increase. All these numbers right here had a big effect, and we know this data is lagging. We go to this chart we've looked at more times than you can count probably at this point. But at this point, the spread's getting even bigger. Right now it's 8.1 to 3%. 3% is where all the other national data is showing where rents are at, shelter costs are at right now. And right now 8.1 is what CPI is showing. So we were hopeful that will level off. That did not. The markets did not like that. But knowing that that's coming, that fills us with some hope in the future that we know that data is lagging about 12 to 14 months. The next thing that we got, but actually, was really positive was PPI. So PPI is producer price index. So not as heavily, viewed as the consumer stuff, but that came in down 0.1% for February. Year over year, it came in at 4.6% increase, but that's down. Previously, it was at 5.7. It was expected to drop to 5.4, but it dropped all the way to 4.6. Core stayed even. That was supposed to go up. And where this could be positive for us is these are the people producing the goods that we consume as consumers. So if they pass on the savings to us, and this again is there's a little lag effect here as they get their savings, now that will trickle down to us. If they pass along those savings, that's really deflationary. That's good for us, what we want. If they just pocket the margins and make more money, that won't help us as much. Next thing we got was initial job claims. Those came in actually under expected. They were expected to get 205,000 new unemployment claims, only 192,000. So again, job market seems to be remaining really tight. So we have to keep a close eye on that because we know the Fed is keeping a close eye on that. Next thing, purchase apps. So purchase apps were at 7.3% last week, and now they're only down 38% year over year. So buyers are resilient. We got some positive move at the end of the week, but beginning of the week was not too good. It went up. So this number will probably be increased again next week with, we've had a pretty positive week this week. How positive? Last week we were at 7.0% was the average conventional according to that lender survey. Today we're down to 6.54%, almost a half a point decrease over the last week. I would have liked it to be more about the inflation and the job numbers and less about the bank collapse. But it's good to see no matter what that we're coming down and getting some of those negative losses we got in February back as we get into March and with some positive things on the horizon. Next thing coming up, important dates. So we got the Fed meeting that'll be next Wednesday, March 22nd. That's when they're going to announce what their next rate hike can be. And this has been really interesting to watch. Going back to last week, this is the CME Fed watch where they're kind of trying to predict what their next increase is going to be, what the markets think. So going, right now they have it about 17%. They're not going to do any increase. That would be actually great for us. And 82%, 83% that it will go up 25 bips. Going back to a month ago, zero increase was not even on the horizon. It was going to be either 25 at 84% or 15% of 50. And then even like last week on the 8th, it would have flipped because of what Chairman Powell was saying. It was up to 68%. There will be a 50 bip increase. Now we're down to no 50 bip increase, probably a 25 and maybe even a 0 bip increase. The European ECB hiked 50 bips today, which is pretty aggressive. That might give our Fed the cover they need to go up to 25 and not do 0. I think they should do 0. They should back off a second, see what happens with all that's going on in banks and and stuff like that, see what happens with inflation coming down, PPI and all that. But that's their decision. And right now the markets are thinking we're going to have 25. So by the time we talk next week, that will be something I can relay to you and see what happens. So if anybody needs anything at all, please do not hesitate to ask. Like I said, it's been a very volatile week, about as volatile as they get. Things are all over the place. So it's more important than ever for loan officers and realtors even to pay attention for their clients and make sure you're locked in when it's good to lock and make sure you're watching that stuff so nothing bad happens for our borrowers. Have a great day, everybody, and I'll talk to you soon.